Good morning to all. Financial accounting is basically required by uh, business people, and business people in the sense sole proprietorship concern, and any individual businessman requires to know whether he is making profit or loss from the business even after investing money into the business. Investment as capital. Whether he has to continue the business or switch over to some other business or discontinue this business or choose some other way of doing business. So for all these purposes, primarily he requires financial accounting. Financial accounting consists of various steps involved in it. Like basically, financial accounting consists of like preparation of vouchers, basically preparation of vouchers supporting each and every transaction of the trade. Then those transactions or passing of journals will be converted into or which will be posted into ledgers, and then out of the ledger accounts, once if get adjusted, then they will take out the final balance whatever shows in ledger accounts, and the balances taken from the ledger accounts will be tallied with the help of trial balance. So after tallying the trial balance, they will be preparing financial statements, in the sense trading profit and loss account and balance sheet at the end of the financial year. You know very well, in India we are following uniform year end of accounting period. That is, uniform year end accounting period ends at 31st March of every year and starts in the previous financial year of 1st April. So the financial period starts from 1st April to 31st March of every year. Now I would like to explain in what way this financial statement helps proprietor or a businessman. When he prepares financial statement in a professional way, once if he prepares the accounts, then it is subsequently given for auditing, which will be audited, and after auditing he gets acknowledgement from the IT department as well as sales tax department, and which is definitely required for sales tax as well as income tax departments. And also the financial statement, which very clearly gives picture about whether the trader is making profit or loss. Not only profit and loss account, and also the income tax department needs to know what is the profit earned in a particular period of accounting year. Likewise, accounting has got various dimensions, which is a separate language we can call it as. In business, they call it as a separate language. So, there are certain steps involved in preparation of accounting. There are separate steps involved in preparation of accounting, financial accounting, basically, which has been defined as per the American Institute of Certified Public Accountants, AICPA. Accounting is the art of recording, classifying, and summarizing in a significant manner and in terms of money transactions and events which are of a financial character and interpreting the results thereof. Attributes and steps involved in financial accounting. Basically, number one, recording. Recording, as I told you already, recording is the first step involved in the financial accounting. Each and every stage of accounting requires a procedure. The first procedure we can call it as a recording. So each and every transaction is recorded into the books of accounts as journal entry. We can call it as a journal entry. Then the recording of transaction which has been classified into various heads, which has got various heads of accounts like the salary, traveling, conveyance, printing and stationery, postage and telegram, and etc. Even staff welfare expenses is also accounted. General expenses, those which are not covered under any of the specific heads, will be coming under the general expenses or miscellaneous expenses. Now, after classifying these expenses, now we have segregated all these heads of accounts and then which will be summarized and subsequently the summarized accounts will be in a significant manner which has to be interpreted, because that is the ultimate aim of processing these financial accounts by any trader or any businessman or any individual, those who are engaged in the business. So, in terms of money, they are valuing each and every transactions in terms of INR, Indian rupee value, which is converted or depicted or represented. Transactions and events of financial character, that is very, very important as far as attributes and steps of accounting is concerned. Then interpreting the results. At the end of the day, we need to know where we are and whether we have to continue the business or whether we have to invest subsequently or any further capital is required to develop the business, or this business has to be closed down or a new business has to be started. So those kind of policy decisions are mainly depends on this successful preparation of or interpretation of these financial data. There are some difference between bookkeeping and accounting, which will be explained now. You can say bookkeeping is responsible for recording business transactions of financial nature in the books of original entry. Each transaction is recorded with as many details as possible. The date of the transactions, quantities and prices involved, the accounts to be debited and credited respectively, the ledger folio numbers are shown systematically. Each entry is made on the basis of supporting verifiable documentary evidence. This is the simple definition for the bookkeeping procedures. Whereas accounting includes the designing of suitable accounting system, preparation of financial statements, cost studies, income, tax work, etc. It is also responsible for analyzing and interpreting the accounting information for internal as well as external end users. Accounting work requires some skill, imagination and experience. The person in charge of this work is called the accountant. Now we are going to see objectives of accounting. Objectives of accounting may differ from business to business depending for the accounting work. The records have to be maintained systematically while maintaining the accounting records. The generally accepted accounting conventions and concepts have to be followed. Ascertainment of profit or loss. So that is the idea behind it. Understand? Accounting is expected to ascertain and reveal the results, the net results of the operations of a business. Various interested parties like owners, management, investors and creditors should be supplied with the results of operations as per their specific requirements. While financial accounts, objectives of the financial accounting, the approach is essential combined with consistency and conservatism. Depiction of financial position, that is the third objective of accounting. Then providing information, lot of information required by the management or the proprietor or the businessman. Now, let me talk about some of the advantages of financial accounting. What are they? Systematic records, number one. Preparation of financial statements, then assessment of progress, then aid to decision making. Fifth one, statutory requirements. Sixth one, information to interested groups. There are several groups like, as I told you already, owners, creditors, employees, financiaries, financiers, tax people, tax authorities, and government may be interested in knowing the businessman's particulars or success of the business. So, we are calling it this group as interested groups. Information to interested groups. Next to this is evidence in courts. Sometimes the court may be requiring evidence details from the parties concerned or from the particular business, which may be required at that time. Taxation problems, and then merger of firms. Sometimes a company may be running on loss or sick, as sick. Industrial sickness is there always. If some company is not doing well, that company may be taken over by the another company. This is otherwise called as amalgamation or absorption or reconstruction of firm, which will be a very common word in the company accounts. Public limited companies or private limited companies, they used to undertake the sick industry, and they may be running with those industries. Two companies may be merged together and form a new company, or a running company may take over the another sick industry assets and liabilities. So these are all the various arrangements made in as per the Companies Act. Then limitations of accounting. Everything has got certain limitations. Even the accounting has also got certain limitations. And in that we can say, in spite of its indispensable position in modern business establishments, accounting has its own limitations. It cannot record all the events and transactions taking place in an enterprise. It ignores transactions which cannot be expressed in terms of money. It cannot measure the qualitative aspects of products, policies, management, and the workers. It cannot qualify the morale of employees in the organization. Accounting relies on estimates and forecasts in several important matters like useful life of machinery, market value of investments. Similarly, subjective opinions of the accountant can influence valuation of stocks, provision on debtors for doubtful debts, and discounts on accounting, etc. Accounting results may not be accurate and reliable due to such estimates and subjective influence of individual accountants. The major branches of accounting we can classify into three. One, financial accounting. Number two, cost accounting. Number three, management accounting. As far as methods of accounting is concerned, there are two methods of accounting. Number one, single entry system of accounting, and number two, double entry system of accounting. Meaning of debit and credit. The word debit is derived from the Latin word debitum, which means due for that. In short, the benefit receiving aspect of a transaction is known as debit. The word credit is derived from the Latin word credere, which means due to that. The benefit giving aspect of a transaction is known as credit. The abbreviations DR within quotes for debit and CR for credit are usually used. By convention, the left-hand side of an accountant the left-hand side of an account is termed as debit side, and right-hand side of an account is termed as credit side. So there are some advantages of this double entry system, which gives a complete picture, a complete records, which is a completed system. We can call it as the double entry system of accounting is nothing but a completed records, completed system of accounting, and then it is very easy to ascertain profit or loss with the help of double entry system of accounting. Thirdly, knowledge of financial position. And fourthly, a check on the accuracy of accounts. With the help of double entry system, we can check accuracy of the accounting system. That advantage is occur. Then, there is no scope for fraud. You cannot cheat. You can easily find out if somebody does any cheating in the accounting system, in the double entry system of accounting, you can easily find out. And then the authorities only accepts this double entry system. Then amount due from customers also within no minute you can find out with the help of double entry system. And then amount due to suppliers also you can find out with the help of double entry system. So finally you can compare the various years amount or figures, and you can do comparison study with the help of double entry system of accounting. Now we are going to see what are the various types of accounts. We have seen methods of accounts. Now we are going to branches of accounts. Branches of accounts, I told you, financial accounting, cost accounting and management accounting. methods of accounting, table entry, single entry system of accounting and table entry system of accounting. Now I am going to talk about types of accounts. Basically, we can classify into two, personal accounts and impersonal accounts. So, personal accounts, you know very well, a person involved in the transactions, and then when you talk about impersonal accounts, can be further divided into real and nominal accounts. Thus, there are three kinds of accounts maintained by a business. You can say personal accounts separately, and then real accounts, and then nominal accounts. So, personal accounts rule is there: debit the receiver, credit the giver. Debit the receiver, credit the giver. Then, when you talk about real accounts, debit what comes in and credit what goes out. That is the principle behind this real accounts. So, as far as personal accounts is concerned, debit the receiver, credit the giver. Real accounts is concerned, debit what comes in and credit what goes out. And then nominal account principle is that debit all expenses and losses, credit all incomes and gains. These three principles generally call it as golden principles. These three principles generally we call it as golden principles. A account student should be very thorough in these three principles. Unless otherwise, it is very difficult to go further into the advanced accounting level, because these are all the fundamentals of accounting principles. So, a account student should be thorough with these three principles called personal accounts, real accounts and nominal accounts. Personal accounts, I said, debit the receiver, credit the giver. Real account, debit what comes in and credit what goes out. Nominal account, debit all expenses and losses, credit all gains and incomes and gains. Now, we are going to see a basis of accounting. What are the various bases of accounting? Number one, cash basis. And then number two, accrual or mercantile basis. Number three, mixed or hybrid basis. So, once again I'll explain what is basis of accounting. Number one, cash basis. Number two, accrual or mercantile basis. Number three, mixed or hybrid basis. So, what is accounting on cash basis? That we are going to see. Accounting on cash basis of all incomes are considered to be earned only when they are actually received in cash. Expenses are considered to be incurred only when they are actually paid, isn't it? The difference between total income and expenses represents profit. No adjustments are needed for outstanding and prepaid expenses. Similarly, accrued incomes and income received in advance are also not adjusted. Thus, income is recognized only when cash is received. Expenses is recognized only when cash is paid. So these are all the cash basis principles. Unless you pay something, literally the money is not going out. Unless you receive it, literally the money is not coming in. So there is no question of accrual or outstanding transactions are involved in this type of or in this basis of accounting. That's what they are trying to explain you. So in this cash basis, literally all the money involved is either it goes out or coming in by way of income or expenses. Next is accrual basis of accounting or mercantile accounting. It is a system in which accounting entries are made on the basis of accounts having become due for payment or receipt. Incomes are credited to the period in which they are earned, whether cash is received or not. Similarly, expenses and losses are debited to the period in which they are incurred, whether cash is paid or not. This is nothing but accrual basis of accounting. Similarly, all outstanding expenses and prepaid expenses, accrued incomes and incomes received in advance are adjusted while finalizing the accounts. This method is followed by all the merchants, trade and industry. That is why it is known as mercantile system. Then finally, mixed or hybrid basis of accounting. This is a system of accounting in which some items of income are taken on cash basis, while most of the expenses are shown on accrual basis. It is hybrid system because it combines both cash basis and accrual basis. In practice, the profit or loss shown will not be realistic. Conservative people who prefer recognizing income when received, but cautious to provide for all expenses, whether paid or not, prefer this system. It is not widely practiced due to inconsistency of accounting. Now, after this, we are going to see in the next spell, we are going to see accounting terminology. What are the various accounting terminology used in the financial accounting? Thank you.